Welcome to the Canadian Investors course, Session 17, Psychology, You and Your Advisor. Please note slide 2, Terms of Use and Disclaimer. This was read to you in full in the introduction. Please read it again. Sometimes in investing, we're our own worst enemies. We're fighting greed and fear. The crowd is going, excel, sell, 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 or sell, 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 goodbye, goodbye, buy, 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 buy. So basically it's the crowd mentality, and that's what we have to avoid to be good investors. So make sure you match your advisor with what you want. Hopefully through this course you've learned about all the different investment instruments and investment styles available to investors. You should choose which investment style you want. Match yourself with an advisor who can deliver that to you. Advisors have higher licensing, can have many investment styles, and a broader mandate. Don't let the advisor steer you to what they want to do or are restricted in doing. An IROC advisor has access to almost every type of investment. It doesn't mean they use everything they have access to. There's nothing wrong with an IROC advisor using one type of investment product. It's their style and may reflect their abilities. Not all advisors apply rule-based investing either. It is a discipline, it requires effort, but it's not extinct. You'll probably find one or more advisors in your community who are willing to make the extra effort to maintain this discipline. Go to the locator on this site to find a trusted wealth professional who can provide you this rule-based investing approach. You and your advisor. First of all, point 1, create an IPS, the investment policy statement. If you don't remember what that is, refer to it in session 13. 2, don't be afraid to ask questions regarding the markets or your portfolio. 3, a good advisor loves an educated client. He or she will help that happen if that's what you like. 4, look at the whole portfolio. If you only want to discuss the stocks that are down and complain about them, do you really understand the concept of owning a portfolio of holdings? Discuss this with your advisor. Even the Dow has its dogs. If you're calling your advisor 5 times a day, that's a joke, okay? It shows you're watching the markets too much and possibly not seeing the longer term picture. It could be the relationship. Maybe you need to look at that. Don't be shy. Ask your advisor about an investment idea. Some of an advisor's best ideas come from their clients. A good advisor will do the research for you and discuss your ideas. Some of them might make sense. Others you'll be happy that somebody looked at it and you don't pursue it. A good advisor must temper his or her client's emotions. At market extremes, this can be difficult. They have research and tools that can help them do this. Take this CIC course. Remember that you have certain level risk. If you demand to match the return of the market index, this may lead your advisor to buy the index itself just to keep you happy, but it would also guarantee that you catch a bear market. Selling into a very expensive market is a sound policy over a stock market cycle. Discuss with your advisor about profit taking, capital preservation, and selling too early. Your advisor wants to make you money. However, both you and your advisor need to keep your risk parameters in mind. Investor psychology. Generally, people buy high and sell low. Online investing and other investment media has caused more inexperienced investors to eventually fall into the buy high, sell low pattern. More trading occurs because of this. The investment advisor community has gone the other way. Trading is rare amongst most advisors' clients. Most accounts are not commission-based anymore. They've mostly gone fee-based. Humans get bold and make irrational decisions at market tops and get scared and make irrational decisions at market bottoms. The bull market since 2009 has not been driven by large earnings growth. That's something to bear in mind. The bulk of the profit in the stock market since 2009 has come from accounting adjustments and large increases in market multiples. Market multiples basically sense what the market is willing to pay for an individual stock. You'll remember this from the lessons. This creates huge emotion and irrational speculating. Investors are pouring billions every day into index ETFs, which benefit from this kind of market. If the market's going up, obviously the market ETF is going to go up. This could present a problem when everyone decides to exit at once as well. Time will tell. Usually, a good discipline for buying investments forces you to do the opposite of the crowd. Investors hate holding cash at the market top and want to be holding cash at the market bottom. Clearly, at the market bottom, you should be putting your cash to work, and at the market top, you should be building cash. That's the opposite of what the crowd wants to do. The buy and hold philosophy is most popular in long rising markets and at market tops. Buy and rule should be popular all the time. The investor psychology cycle. Look at the next slide as the emotion roller coaster that investors go through. This goes for all types of investments. This slide shows you what people tend to think and feel. If you realize this, and you realize that your thinking and feeling is the same as in slide 9, you could be conscious of that. Clearly, at the point of maximum financial risk, when you've gone through that optimism, excitement, thrill, and euphoria cycle, that's when you should be thinking, wow, this is how great I feel about my investments. Wow, maybe this is when I should be taking some money off the table. And then you start to go down the hill, and you realize that, oops, too late. Fear, depression, panic, capitulation, finally despondency. Maybe the markets aren't for me. Point of maximum financial opportunity is at the point where you're just about ready to throw in the towel. Because guess what? Everybody else is ready to throw in the towel too, and suddenly the market wakes up and gets going again. So how can you take advantage of this? Well, again, you have to add a few tools. So, a few investment sentiment indicators that measure psychology. The bullish percentage. How many bulls versus how many bears? Is the market oversold or is it overbought? If it's overbought, as in the lines at the top of the chart, it's probably time to lighten up. If it's oversold, in other words, the lines are going underneath that red oversold line, probably an interesting opportunity to buy. The exact opposite of what the bullish sentiment indicator is showing. Then there's the fear and greed index. This can be found on the CNN website. And right now we're sort of neutral according to them. Well, I'm not sure what now is, but at the time this slide was April 28th at 1:24. I'm going to assume that's 2016. Pretty much neutral. Not too much fear, not too much greed. So that suggests, well, maybe it's neither a buy nor a sell time, which in today's world is probably buy. So the emotions driving the market are neutral. But at the extremes, extreme fear, buying opportunity. Extreme greed, selling opportunity. Index shows huge complacency in the current market. Portfolio managers buy this investment as a hedge in case the stock markets drop. This is the VIX. So when there's huge complacency, it's at the lowest level in history, which means huge complacency. Everybody thinks everything's just wonderful. VIX is very low. It's an interesting opportunity to buy the VIX. But again, be cautious. The VIX isn't an investment for a conservative investor or someone who knows little about the markets. Percentage of investors bullish on the bond market. Well, same thing again. If the investors are bullish, overly bullish, time to sell. Overly bearish, time to buy. McClellan Volume Summation Index. Stock price breadth. The McClellan Volume Summation measures advancing and declining volume on the CIC. During the last month, approximately 0.88% more of each day's volume has traded in advancing issues than declining issues. This indicates the market breadth is improving, although the McClellan oscillator is still towards the lower end of its range in the last 2 years. It's showing some improvement. Um, finally, well, maybe not finally, but sometimes you do something mechanical to help overcome your emotions. And here we're looking at trend lines and crosses in trend lines. And we can see that this is a useful tool because this is a good way of knowing whether the market is turning one direction or the other. Let's look again. October 1987, stocks plunge 508 points. Everybody gets bearish. The world's saying stay out, but it was a good entry point. And again, if we look at our charts, that in 1987, we're not looking at the 1987, but let's look at the 20s and 30s period of depression. You can see here from 29 to 33 headlines after the slide. Below are what the crosses indicated. The buy crosses in 32 led to 160% gain by the time the next sell cross occurred in 1934. And the stock market went up 300% from the 32 low. But in 29, the market was screaming to buy, and investors should have sold. The media, for the most part, reflects fear and greed in the general public. It's been a great contrarian investment signal at the extremes. In other words, invest the opposite of what is recommended. There's a saying, the reason why newspapers are not expensive is because they report history. I'll pay much more if you can give me next week's paper today. Review the headlines below on your own time and see what was said between 1920 and 33. Remember, the stock market peaked in the fall of 29, then fell 80% until late 32, and the stock market went up 300% from the 1932 low. 1929. No cause to worry. The high tide of prosperity will continue, according to Andrew Mellon. Wrong. October 14, 29. Secretary Lamont and officials of commerce denied rumors of severe depression and so forth. 1929. October 29, 29. Crash. December 5th, 29. The government's business is in sound condition. December 28, maintenance of a general high-level business in the United States during December was reviewed by Robert P. Lamont and so forth. Then 1930, business in satisfactory condition. January 1930, definite signs that business and industry have turned the corner. January 24, trade recovery complete. March 8, 1930, President Hoover predicted today the worst effect of the crash upon unemployment is past. This is still 1930. While the crash only took place 6 months ago, I'm convinced we've now passed the worst, and so on and so on. The worst is over without a doubt. American labor may now look to the future with confidence. Still 1930. And on and on and on. Now, scrolling down to July 21st, 1932. I believe July 8, 1932 was the end of the Great Bear Market. Dow theorist Robert Ray. However, in August 12th, Henry Ford has shut down his Detroit automobile factories completely. At least 75,000 men have been thrown out of work. Then March 12th, 1933. Stock market comments by Joshua Kennan. We've talked about the 29 period a lot lately, but what you need to remember is that it was a walk in the park compared to 1933. It wasn't until then that everyone had gone broke, given up hope, and sworn off stocks for life, leaving great businesses trading at double-digit dividend yields and a fraction of book value. The crash of 29 was a blip. The depths of 1933 were like a nuclear bomb going off and leaving nothing but wasteland. Before we get into this, we've already established that stock market prices in 1929 were absurdly high. No rational human being could have possibly acquired ownership stakes on those terms and thought to do well. And the typical issues trading at 30 times earnings, representing a starting earnings yield of roughly half the yield that could be attained by acquiring a long-term United States Treasury bond at the time. Buying the nation's largest bank for 150 times earnings is not a particularly intelligent thing to do when it should be trading at 10 times earnings in a rationally priced world. Still, it's interesting to see how someone who bought in at the top of the market did, acquiring shares at the apex of the speculation that overflowed from Wall Street upon Main Street, or vice versa, depending how you look at it. It was the bursting of this bubble that caused stocks to become an absolute steal, but most people were starving to death waiting in the bread lines. Feeding your family was a higher priority than buying a blue chip stock yielding more than 10%. So that's the end of the actual course itself. The commentary that follows is also interesting. It'll help you set yourself up for the future. It's been a pleasure narrating this for you, and I hope it's been of value. If you have any questions, you can read the slides again, or look for go on the website, locator, and connect with your local wealth professional and talk about it with your advisor. Thanks for listening.